All right, great. We're live. Um, Thank you. I just very quickly want to welcome Alex Kolicich. Actually, is that how I pronounce it correctly?
Yeah, definitely.
I'm just gonna. Well, is there a better way? How would you pronounce it?
Kolicich, that's fine.
Okay, fine. Who I'm just going to read his bio is a co-founder of the venture fund APC. Alex focuses on IT and bio IT investments. Prior to joining APC, he was a partner at Formation 8. Also worked with Peter Thiel as a principal at Mythical Capital. Preceding his venture career, Alex worked as an engineer and early product advisor at Clarium, Palantir, and Google. He was an early member of the Clarium Capital quantitative engineering team with Joe Lonsdale and close advisor collaborator with the early Palantir team. At Google Research, Alex worked on Google Street Views before and during launch. And I think that's enough of a very impressive bio. But anyway, thank you, Alex, for joining.
Thanks for having me.
Yeah. So get right to it. I guess part of the impetus, in addition to just talking about all things venture and capital markets, you have it sort of is partly your background, which is transversed both venture but also public markets and macro things. And recently you wrote something. Well, you write frequently enough about venture, but the last edition also had some specific things on China, which caught my eye. Given tariffs in China, and it's also just generally interesting. So just very quickly, like you have some experience there, like you were when I think from your days at Clarium Capital, you were actually trading Chinese markets, so you have some insight. You can maybe talk a little bit more about that, but I guess the very quick question is you at the time you had some predictions, I guess, about China that were a little ex consensus then. So I guess the question is, is how'd they turn out, and I guess what did you get right, what did you get wrong? What surprised you the most, I suppose?
I think in general, I was correct. It's a little funny because Clarium was Peter Thiel's hedge fund, the global macro fund. And internally, I'd say the consensus was a little more bearish China. If you looked and if you interrogate any of the specifics of China, especially in 2008, you'd see a lot of contradictions. You'd see a command economy or authoritarian economy, which people think is generally less efficient than a market economy. You'd see huge waste in a property bubble, which still exists today. So you could point to any one of these issues and say, oh, well, this allocation is inefficient. The way property rights would be enforced at the local government levels would be inefficient. There'd be huge amounts of corruption, political infighting, huge waste, big projects waste. Like there were examples where in one of these fake cities they built, I think it was in Chongqing, they put all these trees on the street and each tree cost $1 million. You could point to all of these anecdotes where things looked like
They were
grift
really
or
nice trees.
inefficient. They were really good trees. I'm sure nobody lives in that suburb today. You could point to any one of these things and say, look, it's all fake. It's a paper tiger. And what I would remind everybody was if you to understand China in, let's say the 2000s, maybe the 90s, 2000s, and 2010s, the only analog I think would be the Soviet Union in maybe the 1920s, where you underwent sort of a modernization or industrialization in a single generation. And it was sort of typified by huge amounts of investment and urbanization. And the interesting thing about urbanization is you get crazy amounts of productivity gain. So little known fact, during the sort of Cultural Revolution, a lot of the agricultural plots were subdivided so that peasants can have their own land. And so the agricultural industry in China, even to today, is very fragmented and inefficient. And so you'd have really inefficient farmers that would operate on these almost subsistence plots. And you would take them out of a subsistence farming plot, you'd put them in a factory, and you'd literally improve their productivity by 10, 20, 30x. And so even if you could point to any amounts of inefficiency in a micro sense, the amount of gain is so vast, really, it's so vast, you can't understand it from a typical late industrial society like we see today. It's so accretive in terms of productivity improvement that you can have waste. You could waste half of all that and still have GDP growth and massive amounts of GDP growth. So I think that's what a lot of the China bears got wrong back in the day, that there was so much inefficiency, but the pie grew so much it didn't matter.
It was just this huge productivity unlock that was waiting there, which was just like being the exporter to the world kind of thing. And the more that they did that, the more productive they couldn't get out of their own way.
You literally have somebody farming it's a stretch to say your garden at home, but someone's farming a garden at home, and then you put them in a factory making, t-shirts or cars or machinery or whatever. Subsistence farmer probably makes enough food to feed them plus a few other people to somebody who's servicing the world. And so it's really hard to fathom how poor the country was back then and how much value you could create by doing things we think of as ordinary.
Is there any, I guess, two questions. One is, what did you get wrong? But also, before you get down that path, is there any other, I guess you'd call it emerging market that's an analog today, or was that an N of one kind of case.
Probably the thing I got wrong, and everyone there was a mega bear, and I was a, they say like mild bull. I thought at some point the property market would unravel, and that has not happened even to today. And you still see like property developers like Evergrande and things like that going bankrupt, and the local governments are pulling back and the federal governments are pulling back investment in the property sector, and things haven't collapsed. We used to have this joke about the Chinese banks that a rolling loan bears no loss. So I think there's some element of that. It's like you just have all these zombie assets on the balance sheets, and you forgive the interest, you roll the loan, you don't have to recognize the loss. I'm sure there's some of that going on, and so that
Who's
has
going to
been able
call
to
it?
persist. That persisted a lot longer than I thought.
Is there any contemporary analog to what? Is there any 2008 China that's sitting in plain sight? I don't know.
Yeah, I kind of think the analog today a little bit is AI, where you can have those 10x productivity increases that we haven't seen before, where you have virtual humans. And so you had an industrial revolution, which was along material goods. And people always talk about that there's no innovation in the world of atoms, and actually like the last 100 years is the innovation in the world of atoms. So I think people get that wrong. And next it will be this like revolutionary innovation in the world of bits.
Got it. So it's just like a long QQQ, maybe. I mean, we'll get to that later.
It's always long QQ, I guess, but it's funny how that trade can work forever. But maybe you want to buy utilities, maybe you want to buy the precursors, things like that too.
Yeah. Okay. One of the things you did talk, so that's sort of just like context, and I think, right. I mean, I think China was clearly a very bullish story, at least up until recently. You still, I guess, do you still think it's a bullish? Like, that people are saying China's uninvestable. Like, has your view changed? Do you think that they've topped?
Yeah, the irony was I was pretty bullish on it growing, and that it was also uninvestable in many ways. So if you look at Chinese equities now, they've been flat for maybe, I don't know if it's a decade, but for at least 5 years. And people ask about that contradiction, like how could that be so? Well, if you look at the structure of Chinese equities, a lot of them are state-owned enterprises. The way companies pay taxes in China is through, it used to be true, I'm sure it's still true today, special dividends to the government if you're a state-owned enterprise. So in many ways, the government can actually just decide what the return will be of Chinese equities. Also, there's a lot of uncertainty on, trade with the US and capital markets and capital controls and things like that. And that leads to lower multiples too. So you haven't had any real meaningful multiple expansion in China, actually the opposite. And so they've ended up being pretty poor returns, even though the country has grown. I think that could persist for longer than you'd expect.
Yeah, I mean, I think that all makes sense. I mean, to me, like, I think demographics are pretty important there too. I mean, just like the working age population has rolled over, like they're getting older. Like, I don't know that there's any. Seem like my view is
that's one thing the China hawks never talk about. I'm not a China hawk, and we can get into that later. But that's one thing the China hawks, I think, always conveniently leave out, that if you think the next century is the Chinese century, you have to sort of tackle the immense sort of demographic decline that China is about to experience, and how that's going to sort of be a huge headwind to their growth. And then I think there's just limits to, how rich the country can become under its current structure. I always thought it would be like a middle income country, which it's kind of getting there today. It's a pretty inefficient model in terms of the way the economy is run. And so it works in some ways, it doesn't work in others. And so I do think it's very possible they could hit a plateau like most countries in the world do. And they're just a bigger country in terms of population. That's why they're more relevant. But nobody thinks about like Indonesia or something taking over the world.
No, right. I mean, maybe they should, unless you're like long C. But I think it's like the labor price arbitrage is also kind of petered out a little bit, right? Because labor's not quite so cheap in China as it used to be. People keep asking, I need more stimulus. Why don't they consume more? I mean, my view is just the population is it's contracting. I don't know what else.
Yeah, the consumption thing again is something people talk about a lot, and it's really just a policy decision across a bunch of dimensions. One is financial repression on interest rates. They control the rate of interest, so savers there don't make a lot of money. Another thing is a lot of the population works for a state-owned enterprise or is on pension. I think it's up to 40% of the population works for the government, works for a state-owned enterprise, or is on a pension. And so in many ways, the Chinese government controls wages. And so if they wanted people to consume more, they would just increase wages, but they don't want.
Interesting. But I mean, the savings rate is really high, relatively speaking, right? They definitely do.
Yeah. They have a higher proclivity to save for sure, but many people in China are still extremely poor. And so part of that is lack of consumption, is that the entire system is geared towards investment. And all the policy decisions they make, including sort of depressing wages, including depressing sort of rates of return, things like that. All of it is centered around investment, actually. They're making investment look appealing.
But investment in manufacturing, they're not buying equities, right?
People buy equities, but ultimately you buy an equity that's part of a capital market that flows to capital as well. But a lot of like government initiatives, if you look at either 5-year plans or broader plans, and 5-year plans are around dominating certain industries. And then the government through the banks will depress rates of return and push lots of capital to those given industries to sort of like force investment. And so some of it is artificial, right? It's not people are going and the government could, if the government decides to do investment, right, with that money, rather than consume from the government perspective, they could give it in social services, they could give it in many other ways. Actually, in many ways, social services in China are underinvested in. If you're a pensioner and you didn't work for the government or something like that, you might not make a lot of money. You might not have great, late stage elder care. You might not have great medical care as well. So those are policy decisions that they make. That depress consumption. Right. That's why they save more. Exactly. So you get two effects. One, you have to save, and two, you don't get that consumption that the government could be driving.
Yeah. So I'm glad you mentioned it, because you mentioned something about 5-year plans to dominate certain industries. And I just to put a finer point on it, like if I said okay, like China's strategic decision is that the way we're going to grow in the face of our own demographic winter is we're just going to sell more and more things to the rest of the world. And we're going to be the best at it. And like, if we don't have enough domestic consumption, we'll just take the world's consumption, kind of thing. I don't like good or bad. It seems like a reasonable thing to do, but it clearly is like at cross purposes, I would say, with like, some other countries' intention to produce or make kind of things, right? Like, in other words, if we didn't all want to be, the shoppers in Chinese international emporium of manufactured stuff, then, it's a bit of a rock and a hard place there. So what would be sensible policy with respect to China, tariffs or otherwise, or something else, along those lines? Like, I'll just stop there. Like, what would be a smart thing to do? Yeah.
Well, there's two parts to that. So one, does it make sense for China to just invest forever and be sort of the world's manufacturing plant? It made sense for a while to do this, what we call industrialization in a single generation, which has really only happened once in history before. So this is actually really important, especially at this scale. The number of people who were lifted from poverty was huge. A lot of that was driven by production. But at some point, you need to switch from the China side to consumption, because a country that just produces a lot and consumes little works for the rest of the world, right? It doesn't really make sense. You go to work every day. Well, maybe not now, but you used to go a lot to,
I work pretty hard.
There you go. Okay, you work pretty hard. So you work in order to make money and in order to buy things and enjoy your life. You don't work to just invest and then work more in the future. And that's effectively what the Chinese economy does today. So eventually, you would expect people to switch to consumption, because in the long run, we're all dead. So you're not going to just save forever. Now, in terms of that's what the Chinese should do. Now, I don't run the Chinese government. There's probably like a huge resistance to change. I think they need to be doing more market-oriented reforms. What used to happen back throughout the last 30 years of Chinese history, whenever the economy would start to suffer or whenever you'd have sort of issues, they would actually become more free market. Then they would improve. The economy would improve, inflation would usually go lower, and then you'd have more central government control again. Xi is a little bit unique because it seems like he's very focused, or more focused than his predecessors, on government control, and is not doing the sort of standardization or stepping back from control, which we'll see. It's like a little bit. There's no analog in recent Chinese history to know how that's all going to go. In terms of the U.S. side, I'm actually more of a proponent of tariffs than you'd think. But I think tariffs need to be thought of pretty holistically. You need to do a top-down analysis of what industries we think are important, what industries we want strategically to have onshore to America, and have a rational plan with rollouts, with delays, with policy certainty, so that market participants can react to that. And so people need time, people need certainty, and people need subsidy as well to reshore capital in those industries. The current administration has done, I think, none of those things that I said. There's like very little certainty, there's no time to react, and there's no subsidy. And so what we're getting actually is just, I don't want to say chaos, it's not necessarily chaos, but people are frozen. Why would does Trump want me to be in China or not want me to be in China? Is China great and we're going to keep trading with them, or we're not going to trade them? You have absolutely no idea. Either going to be tariffs forever and tariffs are great and we're going to get rid of the Internal Revenue Service because it's all going to be tariffs, or actually it's just going to be a small baseline tariff because we're going to negotiate free trade deals with everyone. These are all like incompatible policy goals that they're saying all at once. So you have absolutely no idea what to do. So you need more certainty if you want people to actually act. And then China has been, I'd say a bad actor in many ways on the world stage. They've been stealing our IP for a very, very long time. And the US government has just done nothing about it. And so I think
why?
Punishing, yeah, it's a good question as to why people maybe didn't want to talk about it. They didn't know what to do. It is hard, but I think you need to have punishments from a trade perspective in cases where you do see theft, like automotive industry for sure, or you would have it in aviation, like the Chinese fighter jets. And that's not the fighter jets. The Chinese commercial jets look a lot like Boeing jets. And so there, I would expect very harsh retaliatory tariffs, but all this stuff happened 10, 20 years ago. And so it's too late now. They've caught up. So it kind of now, I think that's a little bit a relic of the past, where we should have been stricter on them before when they were trying to sort of industrialize and get to the technological frontier. We didn't do anything. And so now they're pretty self-sustaining. There's not much we can do. So I think really we need to think through that industrial policy of like, what do we actually care about having here? And the things that we don't care about having here, we should work to normalize trade relations with the whole world and reduce trade barriers. But I think that's a behind the scenes negotiating point. I don't think it's the President Trump policy of I'm going to pick a fight with every country in the world all at once is not smart, because if you're the big sort of gorilla and everyone is like really small, you want to pick them off one by one. You want to say, hey, EU, I can't sell my, I don't know, electronics because you have this weird regulation that's meant to be protectionist. You get rid of that or I'm going to add a tariff. Hey, China, you're cheating here and stealing my technology. We need a new trade deal. You need to do that one-on-one so you have maximal leverage and you play countries off of each other. Versus like the present thing the administration is doing actually encourages other people to collude with each other against us. So it's just not optimal.
So it's just, I guess it's just to push back on a couple of things there. So one is like, first of all, that going back to the tariffs should be predictable, it should be time, and they should be offset with subsidies. I think the issue with predictability and at least time is like, it is incredibly, capital markets are like water, right? Like, if you give China time, then they just shift, every third Vietnamese business is a Chinese business, right? Like Lesotho is, a massive exporter of apparel to the world as of 10 years ago. Like it's a Chinese export hub, right? Like, so like it does get complicated if you give people time to prepare, and, that they will just find some, intermediate spot somewhere else to route around tariffs, right?
It's really hard to actually address that issue. And so that's why you need to do it from an industry perspective. You could say pharmaceuticals that are manufactured overseas, maybe XEU or places where we can really rely on supply chain provenance, face a 50% tariff, and their precursors face a 50% tariff. What they did was they exempted industries like pharmaceutical products. They didn't exempt precursors. And so for a while, actually, and it might be true today, I think they might have fixed it, but for a while it was actually more expensive to make pharmaceuticals in the US. And so you need time, not only for the market to adapt, which is actually a beneficial part of it, but to craft the right policy with the right incentives so that you can't just, go to a third country and get around them. That's why I think like country-specific tariffs don't always necessarily work.
In industry rather than country, that makes sense to me.
That's broadly, I think, the way it should look.
Just talking about pharmaceuticals for a second, you've described like the fast follower strategy and the ways in which China is arguably getting ahead of us in terms of let's call it, I don't know, whatever you want to call it, bio IT. Talk about that without me bungling it anymore.
Yeah, I do some biotech investing, and we've realized, pretty recently, it's been happening over the last 5 years, but it's become particularly acute today, that a lot of Chinese biotechs are licensing drugs to US companies, US big pharmas in particular, for commercialization in the US and Europe, and that a lot of these molecules are fast follower molecules for innovation that is occurring either at US universities or US biotechs, and it's really hurting the space, because you might be a US biotech, you're going to invest a lot in research and enablement and like de-risking this novel target. that you think might work in cancer. You run trials to show that it works. And the Chinese will have fast follower molecules that they'll really quickly take through a phase 1 trial, that if you have positive data, they'll be maybe a couple months behind, or they can catch up very quickly, of like a similar molecule after a similar target that now that it's been de-risked, they'll be willing to partner it out because it didn't cost them very much to make it to a US pharma company at a fraction of the price. I think the average deal size is maybe $50 million, probably less. Like you'll see people licensing molecules for $10 million upfront plus a small royalty, really cheap. Like the equivalent of, I don't want to say it's dumping, but like the equivalent of dumping in biotech terms. Most biotech investments fail. And so when you have one that succeeds, you need to be making hundreds of millions of dollars on it, not 10 million. But because the investment on the China side is so low, they have so many people and a pretty good clinical trials infrastructure, they're able to recreate these things that are like a fraction of the cost.
Is that a comparative advantage or is that cheating?
I would say it's my policy prescription here. There's two ways you could tackle it. It's not cheating because it follows US IP law. There was this case, Amgen versus Sanofi. It was 2013. I forget when the case was, but it put a pretty high standard of enablement on being able to file IP against a given target. And so you can't, in many cases, easily patent a target. And so if all the IP you have is a target, then probably people who are really motivated will get around that. And so it's not really cheating because it does fall into US patent law that this is okay. And it's US companies that are commercializing these things. So now that law could be changed. So we can make a policy decision to say, hey, we want to help our small companies and we want to enable sort of stronger protection on targets, at least novel targets that are de-risked by somebody. I think that could be smart. But to the extent we don't do that, we don't change the way the law works in the US today, I think it is a competitive advantage. And phase 1s in China are faster. Phase 3s in America are faster. So it's not that we're like slower everywhere. It's that they are really good at this fast follower approach. And so I think the real conclusion I put in my piece is that US companies need to get better. They need to get leaner. So we need to learn how to make medicine more cheaply. I've been writing for a very long time on how the US biotech industry is like very fat. They spend too much money.
Is that regulatory or is that because of something cultural with the companies themselves?
With the companies themselves and the way they're started. They're usually incubated. They have professional management teams. People in tech will read Lean Startup, and that's kind of the ethos in tech today. In biotech, there's nobody wrote the Lean Biotech Startup Handbook. And so first thing they'll do usually when one of these biotech funds incubates a company is they'll hire ex-pharma leadership. And what ex-pharma leadership does is recreate pharma in the biotech. So it'd kind of be like I start a startup in tech and then I hire, all ex-Microsoft people and then we recreate, or IBM, let's say, and then we recreate the IBM management structure.
But why are they doing that? Like, in other words, is it signaling? Who are they signaling that credibility to? Why do they keep making that same mistake over and over again?
I think they had been making it because they could. And now I just think the game is over and China is pushing that. Like, you're not going to be able to do that for the next 5 years. Funds are either going to adapt the way they do things, outsource more, be more lean, or they're going to die. And so that's why you see today in the biotech venture space or even crossover space, it's very, very hard. I mean, you look at the public biotech space, it's very hard too. If you look at the XBI index, the returns have been terrible. I think it's down 20% this year. And I think this culture, this pervasive culture of excess needs to go away. And there was never the incentive pushing it before. Now the game is over, right? You're going to be fast followed by a Chinese molecule. And so you need to be cheaper and faster.
So there's no legal or regulatory barrier that you're aware of spinning up a fast follower manufacturer in the United States. Like you could do it.
You can make it harder for somebody to create a fast follower molecule, but you can't just blanket say nobody can go after this target which I've identified and de-risked. You can create you can have a patent around molecules that are 90% similar to yours or that have these modifications, things like that. So you could put up barriers that make it harder, but you can't prevent people fully.
Interesting. But again, like if I wanted, let's say I obviously can't, but like if I said, okay, I think this is a great opportunity. China's doing this. I want to do this in North Carolina. I'm going to be a fast follower too. It's not like the FDA is going to come say to me, I'm sorry, no, your phase 1 trial, I don't know the trial as well, but like saying, no, you just can't. Fast follower is not a thing that American manufacturers can do because you have to run through all this testing and stuff like that. It's like there is in fact a shorter on-ramp provided you can do it, or maybe not.
There are a little bit of issues where Chinese companies don't need GMP material for phase 1. And so that makes it a little bit faster. They have a larger population, that makes it a little bit faster. They have better, more streamlined IRB approvals in China, which makes it a little bit faster. But I think, in general, pharma companies would prefer to work with US companies. And so I think it's possible to create a US company that's going to make molecules cheaply, that's going to run the trial either in the US or internationally. We don't have to run the phase 1 trial in the US. You could run it internationally. It doesn't have to be run in China, with maybe GLP material, or at least, less strict standard on the GMP side, and compete on speed with Chinese companies. I think it's possible. And so, we're looking at funding some companies that can do that.
Interesting. Okay.
Do you think nobody biotech is wired to say, how can we do it as fast and as cheap as possible? There's huge amounts of scientific rigor, which is good. And there's huge amount of regulatory burden that we all accept, that we've all accepted as good. And some of it is bloat. And so I think you can get around a lot of it by going to third countries that are allied countries. Like Australia is a famous one, where you can do a trial faster and cheaper in Australia. You've been able to do that for 10 years. So that's one very clear example. You could run a phase 1 in Australia.
Yeah. It's just, I guess, my priors are that bloat is usually, is protected somehow, right? In other words, there should be some regulatory barrier to entry, because certainly America, if you could do it cheaper and more quickly, that's certainly something we generally, we try to do. Or at least somebody's going to try to do, right? Because if they can make money doing it, they will try. Yeah.
Well, there just hasn't been that credible threat, right? It's you have an industry, you have a way of doing things, you add heuristics and standards on top, and it builds up over time. And there are companies that are heterodox and question them, but the majority don't. Majority of people are trained sort of in big pharma, or trained of a certain way of doing things. And the incentives in biotech grew in a way that management teams are more incentivized by salary than equity. And so just culturally, these things eke up, and it's a high barrier to entry industry. It's not like you can come off the street and say, I'm going to start a pharma company and do it smarter and better. Your startup capital needs to be $50 to $60 million. So there are gatekeepers to entering, and the gatekeepers, not that many of them, they do it a certain way. And so you need something, I think, to just shatter the status quo, which is what's happening.
Interesting. So you're it sounds like you're sort of long-term bullish in the US's ability to catch up here without actually having to do anything, make any big changes. They just have to light a fire and get going.
I think we can make we can either change patent law, which I don't know if, there's not a lot of...
Let's assume political...
I don't know.
Yeah.
Well, I don't know if there's a lot of sympathy to say, Trump is trying to reduce prices of drugs. I don't think the movement to increase patent law to extend high drug pricing is going to be a big pitch on the populist side. So I don't think that's going to happen. But I think there's things you could do on the margin at the FDA to reduce sort of GMP requirements for phase 1s. They're working on reducing the need for certain animal studies, which can make sense in IND packages. And then the rest. So I think you could do some things on the policy side, but I think the majority of the benefit is improvements are going to come culturally.
Interesting. Okay. So what about, it's just shifting gears a bit again, to still focus on China for a moment, in terms of structural advantages or not. With respect to AI, DeepSeek, et cetera, you also have a perspective there. What's your... Yeah. Go ahead.
Yeah, I think, it's a broad question. I think the DeepSeek moment, which when it all happened, we're so in AI here, we're reading, research papers the day they come out. We're interrogating models the day they came out. And so a few funny things happened with DeepSeek. The market reaction to it actually came 7 to 8 days after it was released, which is really funny. So that weekend when all the stocks were crashing and Nvidia was crashing because DeepSeek...
Why did that happen?
DeepSeek is commoditizing AI, and we were all kind of looking at each other saying, yeah, but that was a week ago, what is happening here?
And also, the commoditized AI was out there as well before. You don't need DeepSeek to commoditize AI. Just why can't that?
There's a fundamental misunderstanding there that they didn't advance past frontier model. They were slightly... Let's say they were frontier, but they weren't the best model in the world. The cost argument everybody said was, they trained this for $6 million and everybody else was doing hundreds of millions of dollars, is not true, or rather, it's not innovative, because we've seen many examples in AI where when you know exactly what to do, and the exact model parameters to run and the exact model architecture to use and the exact data mix to use and all the steps, it's cheap to do the run. Like, everybody knows that. It's all the steps in between that are expensive of saying you're going to try many architectures that don't work. You're going to try data mixes that don't work. You're going to have data sampling that doesn't work and multiple epochs. All the steps in between you are trying and tweaking, and it's a real empirical science, actually. It's not theoretical. And so all of that stuff is expensive, and DeepSeek certainly had to do that themselves too. And it was expensive for them to do it too. And once they found the right recipe, it was cheap to do. And that's true of every model provider in the US too. There was nothing, I'd say, unusual there. Certainly, then there was also all this cope, I think, that came out that said, oh, they copied OpenAI and they stole OpenAI outputs and things like that, to which I'm also skeptical of, because if you look at, DeepSeek is a fairly open model provider, and they publish a lot of research. And if you look at the things that they publish, it's good. It's like, if you read their papers, they do good research. They're really smart. You'd expect people who do good research, who are very smart and who have enough GPUs to make a good model. So, we didn't have to.
Do they have enough GPUs?
It seems like it. It seems like they do. There's been a lot of conjecture. I don't know. Yeah.
Well, I'm asking is because you did make the point, actually, that in some ways, while China is getting very, on the bio, the biochem stuff, like on AI, it's like people are focused on the wrong thing. It's like, great, okay, they made a model, but the models are, they are the relative commodity. Where they struggle is with, and where the tariffs are hurting them, or at least the import controls, is on the inference side, right?
Exactly.
Is that
exactly?
Yeah.
Absolutely true. Yeah, I don't think we're going to be able to stop China from training frontier models. But with the export controls that we have, we're able to slow them down on inference in particular. So if you look at most companies that are training models like XAI or something, there was rumors they had a 200,000 GPU data center. Some of that certainly is used for training, but then some of the compute you have is used for inference too, to be able to actually serve the model. And you're going to spend more compute economy-wide serving the models, because the act of training is not that useful. Right? Okay, I train a model, I have a model now, but unless that model could do actual work in the real world and perform requests and service requests, then it doesn't really help me. And that's where they're going to have a challenge, is in the short term, I would say. They're not going to have enough GPUs to service all of China if they want to sort of move towards adopting AI in industry and things like that. But I think that's going to be very short-lived, because the moat that Nvidia has in inference is much lower than it has in training. It's very hard to train things outside of the Nvidia ecosystem. People have been trying to train big models on even AMD GPUs for a while, and I don't think anyone's done it at any meaningful scale. You can service models or do inference on AMD GPUs, and it might be less efficient, but you can do it. And so Huawei has a bunch of new hardware that they're putting out, which certainly will be able to inference really well. And soon there's a lot of software work you'll have to do to train on those chips, but we'll be able to do training as well. So I think, I wrote in my piece that we put export controls at the wrong time, I'd say, where we've now created an incentive for China to create a credible threat to the CUDA ecosystem, sort of the software package that NVIDIA has to make their chips work. And we really should have waited. We should have waited until AI was doing useful work, and then you pull the rug from under them. But now it's so frontier now, and it's so speculative that I think within 3 or 4 years, they'll catch up. And there was actually rumors, and this is public rumors, but that NVIDIA was trying to create a partnership with Huawei to allow them to use CUDA.
Why would they do that? Just because the end market's so big?
That's their moat. So if I'm NVIDIA, my real lock-in is not hardware. Anybody can make hardware. It's a lot easier. AMD makes amazing hardware, but CUDA is my moat.
So they want to take away the incentive of anybody to... But so they don't want anybody to make it themselves, basically. So
they'd much rather have the CUDA ecosystem intact and lose the hardware in China than they would to lose CUDA, I'd say.
And I guess they would trust the fact that they wouldn't reverse engineer it or something. That's too hard.
You could try, but the NVIDIA stack is so good that it's even on the NVLink switches and things like that, there's computation that gets done. So I think it'd be really hard to rebuild what NVIDIA has built, but you could build something that's serviceable. And if you have a whole country that's incentivized to create a new training ecosystem around a new sort of platform, they could do it. But it is like a nation state type effort to get off of CUDA right now.
Got it. Yeah, so but they'll get there eventually. So basically cat's out of the bag. There's no, it's an infinity game race kind of thing where on AI it's never gonna end. There's no waste.
It's viewed as existential in China and everywhere else, that you can't be behind an AI. And Huawei is a national champion, so Huawei is going to probably subsidize the hardware, and the whole country is going to be incentivized to sort of build up on Huawei. And then any other country that we, put export restrictions on as well is going to be incentivized to use the Huawei ecosystem and build on it as well. So it's going to be this like global south. Whoever is cut off Nvidia ecosystem will be fighting against Nvidia.
Interesting. Unless Nvidia can find some way to make peace with everybody. Yeah.
They're trying. I doubt they'd be allowed to do that. And it was just a rumor. I saw it. I was like, I bet they're thinking about that. Jensen's a capitalist.
Yeah. Yeah. No, and he's awfully good at it. And I guess nobody else is in, by making sure there's adequate supply out there. He also similarly just sort of removes the distance. It takes away the incentive for any American companies if they would try to build a competitor also. Or do you think that's coming?
I think it's coming on Inference. It's coming. You already see it. There's Grok and Cerebras. There's all these people who can run inference on models. I don't see it on training. People are trying to do more like open source training initiatives, things like that. But I don't see anything coming on the training side.
I'm back to AI in a second, and maybe even China. I just want to switch gears a little bit because I'm cognizant of time. Let's talk about like just venture landscape and cap markets more generally, because it's also a thing you talked about, but it's also top of mind. Liquidity, obviously, is a thing, or a lack of a thing. I have something that I often say, which is like, the public markets are wide open, which is, the public markets right now are paying historically high earnings multiples for growth companies or any companies, right? So like public markets are certainly willing to buy technology stock. So why are there no exits? Like, people, the IPO markets aren't open, they're wide open, right? I mean, maybe not.
I'd say it's the parts of that are true, parts of that are not true. It's terrible in biotech now, for example. Like it's Armageddon. Many companies trading at negative enterprise value, XBI trading well below the market. So it's not true that.
Why is that? There are companies that are trading below cash, which is kind of amazing.
It's usually pricing in a lot of things. Either you have a bad drug. There was a huge mania in 2021. I won't bore you with all the details there, but a lot of bad drugs and bad IP got not fraudulent, just bad, not going to result in a molecule that works, got funded. And so the market is saying, these guys are going to burn my capital. They're not going to return it. So it's worth negative.
Right.
I'd say that's primarily the issue. That you also get into like situations where somebody has money, but not enough money to fund through a value inflection point. And so until you raise enough money to fund you through that value inflection point, you're either pricing in a lot of dilution or you're just destroying value. Unless you have enough money to prove the drug works, nobody will ever invest in it. It's very binary.
Should venture investors be doing more biotech SMID-Cap investing then?
That's been what a lot of the crossovers have gone, is doing more pipes in public biotechs and retreating from the private market. So that's happened. But again, it's definitely a buyer's market out there. There's more biotech companies than there are investors. Especially, and it doesn't help that the public stocks haven't done well. That's been the real challenge there. On the SaaS side, if you look at the average sales multiple, because you're right on the earnings multiple that we're, I don't know if it's quite a record, but it's 95th percentile. But if you look at revenue multiples,
the record was 4 months ago. Now it's just the 95th percentile.
There we go. If you look at revenue multiples, which is what we'll usually price things in the private markets at, they're not at 2021 highs. They're not even close. They're down maybe still 60, 70% from the highs. That has meant a lot of companies have to grow into their valuations to go public. In general, I'm very sympathetic.
But revenue multiples are stupid. Right? I mean, I guess like part of it, like revenue multiples are a useful proxy at a very early stage of a company when they're deliberately in capital consumption mode, and you're trying to use revenue as revenue growth as a proxy to with positive unit economics means that eventually they're going to be a high margin business. And revenue multiples where you're just spending money to make to make money, but you're not actually making money, like that was the thing that got way head over skis, right? Like that was never real. Like earnings is ultimately what people ought to care about.
Yeah, earnings in some ways can be backwards looking, and revenue can be forwards. A company that is going through hyper growth is not going to have earnings and will not have sort of steady state earnings. And so how do you price it? You make some assumption about what margins will look like. Maybe like if it's a software company, a SaaS company, they all look kind of the same in some sense. And so it'll probably have 20, 30% net, operating income margins at some point, and it should be this on revenue. Otherwise, if a company is growing really quickly, there's no analog on growth in the public market, then there's no earnings. What do you price it at? Like, how do you put any value to it at all?
Well, I guess you try to look at their, their unit economics, and you try to make some assumptions around, okay, you can model future earnings growth at some point. You can say, okay, they're adding revenue at a multiple of OpEx. And if the market size is some, they'll get there eventually. Like, at least you could try to plot where the lines intersect,
But then you're kind of
with
actually saying the same thing, right? Because you're making an assumption on what earnings would look like in the future, and then doing a multiple on those earnings, what it would be today, normalized, for example, which is the same as a revenue multiple. And if it's a less profitable business, you have a lower revenue multiples. That's why it's a pretty good proxy for companies that don't make earnings, and most companies that are private don't make earnings yet. And a lot of people criticize this, but then that's why we have a robust tech market in the US, right? And extremely profitable companies come out of this.
Do you think that, so right, that's true. But so do you think then the public market is putting too high a discount on revenue multiples?
No,
And
I
they-
think the multiples are fine. I've been wrong about this call. This is one of the things I got wrong last year. I thought people would start accessing the markets. A little bit, there's been this movement in Silicon Valley against going public again. And so I think, again, there's like another cultural consideration where companies are, I'll say this was like very Peter Thiel. Peter would always famously say, like, don't go public, create value in the private markets. It's easier. You can have more patient capital. And so I'd say that idea has gotten more popular again in the Valley. And so there's that. But honestly, I don't quite get it. I think more companies should be going public.
Because why? Because just cheaper access to capital?
Well, everything you said. Well, yes, eventually you want to go public because it's a lower cost of capital. You now have a currency to do acquisitions. You get liquidity for your shareholders. You get liquidity for your employees. Again, in the long run, we're all dead. So we could be doing tenders every 6 months, but that's only reserved to like the top tier of companies. Eventually, to get liquidity, you have to go public. And so I think it's like an inevitability that all companies should go public. That's kind of the exit path if they're not going to get acquired. And so you might as well do it when the window is open. There's a famous saying, the time to take a tart is when they're being passed. And so if the window is open and you're doing well, like, go public. Because the window might not be open, you might not be doing well in the future. And so I'm very surprised more companies are not doing it, to be honest with
you. So your view, I guess, because one possibility is that the bid, I think what we've seen recently, of course, is like they can go public provided the last in investors take a haircut, right? Like that's
at Service Titan. Service Titan has done pretty well, and it's like an okay SaaS company. We're not talking about Microsoft here. It's like okay. And CoreWeave, which was very skeptical, has gone up a lot now too. And so I think the public markets for most tech companies are pretty, favorable. And so I think people should make use of that. And there's a huge dearth of IPOs. And so if you actually make the plunge to do it, you're not competing with like all these other hot assets. So it seems like a great window for like the mid-tier of companies, to be honest with you.
they should be doing it. I guess, but your view is I guess the other concern is just like the reason they're not going public is because if everybody had access to their earnings, the revenue profile, they would just they might see a shitco. But you don't think that's the case.
Well, there's a gradient, there's a bunch of shitcos. A lot of them SPAC'd. So we eliminated the supply. There's always some, but there's a lot of companies that are great. There's a lot of like mid-stage SaaS companies, vertical SaaS companies that can go public. And if you look at Service Titan, it's like you should. Cost capital is lower. The market wants to buy these things. Everyone understands the sort of net revenue retention growth story. It could be very capital efficient. It's like very favorable. I talk to bankers and they're all like, yeah, people want to buy this and there's no competition. So why aren't companies going public? I don't know.
Yeah, that's weird. Or being bought by private equity or some other company.
But we're seeing more private equity buying. We're not seeing people going public.
Yeah, this week was decent, but yeah, that's interesting. So I guess, I get the argument in favor, I suppose, of the secondary stuff is just like, if there's enough money migrating to the private markets such that the best companies don't need, they don't need access to public markets, then why would they? Why would they take why would they take the trouble, I guess? But like, do you think, like, why aren't there more pure play VC firms trading in secondary? If that's like, in other words, you're describing almost like an arbitrage opportunity where they're not going public. They should be, perhaps. They have ready acquirers. They're valuable companies at some price. If anybody has special information about these companies, it should be VC. So why aren't they all of them spinning up secondary strategies or something like that?
There's a technical reason where to buy secondaries, most VCs operate in an exempt manner. They don't have to be RIAs.
So they're
This
not
is just a
IRA. Okay, fine.
VCOC exemption. And so if you start buying too many secondaries, you lose your exemption and you have to get registered. So that's become less of a barrier because more firms are getting registered. But for a very long time, that was one of the major barriers, is if you started buying a lot of secondaries, then you would have to register as an RIA.
Be a registrar.
And that's a huge sort of like overhead increase that, unless you're a very big fund, we've looked at the price. It's quite expensive. It's prohibitive unless you have, billions in assets under management. So that's one. Two, I think it's been cultural in some way. Secondary so there's only a few firms that can afford the sort of overhead of buying secondaries. At the same time, secondaries have always been looked at as a tier 2 asset class, where you don't get liquidation preference, you don't have any preferred protections, you don't get much oversight into the company, all that, which means if you are big enough to be registered and you are sort of important enough to get access to the information on these private companies, you view it as a little bit beneath you to buy secondary when you could buy primary. Because you buy primary in a company, you get protection on your money, you get say in the company's governance and all that stuff. And so most people have gone towards that. Also, most companies are still in the mode of, it's scarce enough that people know about them or want to invest in them. And so they want the money on the balance sheet, right? It's like, we know of these like very high flyer assets and Dural and SpaceX and Databricks and Stripe, where people are falling over to give them money. That's not true for the average company. For the average company, if you would go to them and say, hey, I want to buy secondary, they would say, I just want to take it on the balance sheet because I need operating capital. So it's a confluence of all those factors together. But I do think it is actually a underserved opportunity and underserved market that people is still ripe for people going after.
Yeah. In other words, I guess like part of what I'm sort of fucking around is like, it's almost like you're saying there shouldn't be a liquidity. There is a liquidity issue, but there shouldn't be for some reason.
Because most companies are not known and don't have this like overwhelming amount of capital going after them. But there is that middle tier where they're like doing well enough, they're profitable, that people should buy more on the margin secondary. But I don't think it's going to be like, it's not an alternative to going public, as an example. Like, I don't think that market will ever be big enough or liquid enough to be an alternative to going public, except for like the best assets like Stripe and I think SpaceX do tenders every 6 months. That's like pretty inefficient. To access these tenders a lot of the time, you have to go through an SPV with high transaction costs. Are employees getting the right price? Who knows, right?
Nobody knows. Yeah, no auction process.
It's not efficient. I would love to buy Stripe. I can't buy it. I'd love to buy SpaceX. I can't buy it. So my bid is not in the price.
Yeah. And yet they keep doing it, I guess, because they can. But I suppose that so it's almost like who's failing here? Is it the bankers? Is it the private equity people? Is it the regulators? Like who is not getting the job done to unlock liquidity in a way that it should for all of the above?
Question. Everyone loves to blame regulators and say it's too onerous to go public, and there's probably some element of truth to that. But
I love to blame regulators.
I really do think. I mean, I keep going back to it. I think there's just like cultural like ways of doing business that develop in countries or in industries, and I think this is one of those that's inefficient. And the zeitgeist would need to switch towards telling companies to go public early. Like, I went to school at University of Waterloo, where the biggest employer when I grew up was, or when I was at school, was BlackBerry, or RIM as it was called at the time. And RIM went public on the, Toronto Stock Exchange pink sheets when it was a $50 million company, maybe less. And so all the value was created in the public markets. That's because Canada has a culture of like junior miners that go public on venture exchanges and raise money really early on in public exchanges. And if they hit it big, then they graduate to the TSX. And that's what RIM did. And it was just happening to be a technology company. A cultural practice that has developed. We would have to make some push like that here today, where we push companies at a Series B or C stage to go public. Like, if you were in the public today and you want to get access to AI innovation, you can't invest in OpenAI, you can't invest in Anthropic, you can't invest in Grok. You can invest in Google, where like a subset is model development. You can invest in like Alibaba and Baidu and some of those companies that have their own models, but you can't get access to that. I don't think that's good from a societal perspective. I think everyone should be able to have access to it. So we would have to push companies to go public.
Venture companies should be making more friends with SMID-Cap investors, I think, right? Because that's like that should be a natural exit ramp for them.
And it could
So I
happen.
have.
You could go public in Canada. It's just there's no culture around it.
Well, it's funny. Actually, a friend of mine who I was interviewed, Blake Janover, founded a company, Janover. He actually went public on Nasdaq at I think at a $4 million valuation. It was something I never even knew was possible, but he did it for various reasons. And actually, ironically enough, was the company was bought by former Kraken people recently, not for core Janover, but they wanted to basically do a MicroStrategy sort of thing, and they bought the infrastructure. Yeah, so it's actually it's I think like been I think it's like almost like an 8,000% return or something for other reasons. But anyway, it long different story.
Yeah.
I have a hypothesis, and I'm curious whether you think it's true. That there is a universe of venture-backed companies that, having turned over the cards, have found some product market fit, but they're not hyper-growth companies. They can be run sustainably, profitably. Maybe they compound earnings 5-10% a year. A, is that true? And B, I guess, like, what ought to be done with them? Are they being sold to private equity? Can they be spun out? Can they be recaps? Like, I just don't see too much of it. And like, is the issue there that I've seen it anecdotally, and like the biggest barriers have been, either the equity is so underwater, and that just nobody has the incentive to like do any of the work. They'd rather just sort of hold on to the lottery ticket rather than kind of invest too much mind share or money into figuring out some other off ramp. That's been a thing. But I'm curious, I'm curious
Well,
what
look,
your thoughts on that.
a lot of people will blame the venture investor, but look, we're minority investors, so we can't engineer an exit. I could say you should sell it to private equity. I can't tell the founders what to do in most cases. I do think most of those companies should go. First of all, there are a lot of those companies. A lot of mid-tier vertical SaaS companies eventually will get a couple $100 million revenue, and they grow 10, 20, 25% a year. That's okay, by the way. If you look at the average SaaS company, public SaaS company, it grows, I think it's now 10, 12% a year. But most companies, there's very few growing above 25. So it is a market of mid-growth companies, or even low-growth companies in some sense. And that's okay. And so there should be more of that culture of companies going public, in my view. But it's an inefficient market because, you start talking a little bit about family businesses now in some sense, where an entrepreneur runs a company and they want to run it. And so they don't want to sell it to private equity buyer. And so it's a question of staying private or going public.
But like right now, they're sort of stuck in a purgatory, right? Where like their equity's underwater too.
Well, if they wanted
know,
money, they would sell the company, right? But a lot of people want to build their empire, and a lot of great family businesses have been grown by compounding 15 to 20% a year for 20 years. That looks pretty good. And so if the entrepreneur has a time horizon of, I think a lot of times entrepreneurs overestimate the ease of starting company number two. Certainly, repeat entrepreneurs succeed at a higher rate, but it's still not a very high rate. And so a lot of times if you're an entrepreneur, you found product market fit, you created this great platform, let's say in some vertical where you're the dominant player, your economically optimal option is to actually just run it and keep compounding for the next 20 years, probably, versus starting something from scratch.
In this case, like they may, given preference and waterfalls and things like that, their equity, they might not see a penny. Even if the company is valuable, it may not come to them.
Well, over time, like unless maybe you have some like preferred dividend or something like that, but most capitals are not that cap tables are not that funky. Usually it's pretty simple preferred equity. You'll grow out of it. But I wouldn't say most of these companies are underwater from a pref perspective. I'd say they're just underwater from a last round valuation perspective. And if you're profitable, which most of them are, if you're growing 10, 20%, you usually push to profitability. There's no impetus, you could just keep going.
Keep going, except that somebody, I guess, right. So it's almost like you're coming to that point, like there is a liquidity crisis, but there shouldn't be, or at least there shouldn't be as much. Like these are basically healthy companies. There are liquidity off-ramps that just choosing not to avail themselves, which is
absolutely. I think that's true for most.
I think that's a contrarian take. I don't think most people would say that. Quickly, and I'm again cognizant of time. So I guess like dumb money. you've written about dumb money before, and you said like dumb money drives up prices and lowers return for everyone. I guess isn't that true of any good strategy, right? Like that eventually it attracts enough capital to drive up price.
But venture is unique. Venture is unique because you can't make money off the dumb money. So if I think stocks are overvalued, I can short them. We were talking about CDOs in the 2008. If I'm Goldman and I think CDOs are worth nothing, I could buy insurance on them or something like that, and I'm going to make money when it blows up. But in venture, you can't really short that easily. And so the challenge in venture as an asset class is if there's dumb money, it just destroys the returns. The smart money can't find ways to short or go here or there, it usually just returns to the asset class.
Right, so they just can't take the other side of that trade. Yeah, that's interesting.
Exactly. Unless we
We
make
should start.
synthetic equity, which no one's done before, but I think is technically possible.
I think this is the next business is we're going to create a synthetic DC vehicles.
There'd be very big challenges to margin and things like that, which probably means it never happens.
It sounds complicated. Yeah, that would be funny. So I guess then, do you like more broadly, like, do you think that the asset, like if more money flowed into venture, you would get more venture backable companies, or no? Like there is a bottleneck on how many actual venture backable companies there are at any given point.
There was for a while, but I think now you can like infinitely scale these small sort of AI wrapper companies. They're so easy to start. It's unique. LLMs are really unique because the capability is so new and so broad, and so it's such a step function change that you can really quickly make applications that would have looked very complex 5 years ago because the LLM.
That's not good.
Companies,
Those going to be big enduring businesses?
but like dumb money doesn't invest in big enduring businesses, right? It just invests in anything.
Not to be venture backable is basically what you're saying.
A very good mentor of mine when I was at Clarium told me the remedy to an excess of capital is capital gets destroyed.
Yeah, and I think that's happening. That you think that's going to? It certainly has happened in venture. Do you think it's going to continue to happen? Is there another shoe to fall, or is the correction basically over?
I don't think it started. I mean, I think we're still.
It hasn't started. I like that.
No. I mean, look, I think we are really at the start of a new industrial revolution. So I think it could just circle back to the China point where the amount of value created eclipses all the stupid investments that have happened. So I think this is generational wealth is going to be created in this cycle. And so any loss we see on the margins of like some wrapper company or maybe like the frontier model, companies are not worth trillions of dollars. They're worth $100 billion. And so people lose money on them. I think it's going to be a drop in the bucket relative to the wealth creation that's going to happen.
Are you persuaded by the whole bifurcation of venture? Like do you know that discourse? All the money's flowing to the biggest firms, and emerging managers can't rate. Like, do you think that's a new normal? Do emerging managers stand a chance? Like, should anybody be competing with the so-called platforms? Like, how does that? Do you have a view there, or are people just overreacting and it'll just basically be the same old soon enough?
That is a new trend. I had a graph on this, I think it was 2 quarters ago or 3 quarters ago, that like we're at the lowest level ever of first fund allocation. So the venture or LP allocation to first time fund is the lowest ever. And so that's kind of showing you what you're talking about, that you're seeing a big concentration in the big mega brands and, less dispersion on the lower end. I do think that's probably going to keep happening. All the big money managers haven't been in venture for a very long time, like the sovereigns and things like that, and they wanted avenues in. And the avenues in are usually people who could take very large checks. And so you need these like mega scale platforms to basically allow for that. And over the past, say, 10 years through 2021, we've really institutionalized the asset class more. It went from cottage 30 years ago to institutional now. And so I think the days of there being tons of upstart new venture funds are over. That doesn't mean there's no, room for new funds. I think the seed stages, the early stages, like angel, seed, probably not Series A, but like bridge financings between seed and A, you can always start a fund to do that. The big mega funds are not very efficient at that because, a $500K check, a $2 million check doesn't matter when you're managing $7 billion. But once you start getting to Series A land, I think it's very, very hard to be a new platform. Like, will we see a new one ever again? Yes. But I would like wager that the rate of new firm formation is going to slow on the sort of like a more.
I think that makes like a new. Does that make like emerging managers a good buy fear sell greed trade? Like if all the money is fleeing EM, like new funds and emerging managers, does that make it a good time to be allocating?
I don't know. It's not like you're getting in at better, like a lower price or anything like that. I certainly would it's funny because I think sometimes fund ones are the best funds, but that was true when you're talking about a space that's not institutionalized. So, what used to happen in the past is you'd have a bunch of people who come together, start a fund, work really hard for the first fund, and then over time they make money, they get lazy, they buy second homes, they buy planes, and they stop working as hard, and the returns falter, and eventually the platform goes away. And that's when it was a cottage industry, right? It was much more about a bunch of people coming together and making a fund. But now it's institutionalizing. And so if you look at Andreessen, it looks more like a Goldman Sachs than it looks like a benchmark. And so that makes me think that there'll be more enduring value or enduring returns to these platforms than there was in the past. And so maybe first funds are not as good of investments as they used to be.
But money is exiting for good reason. In other words, they see competitive advantages to the platforms. They're just good. Yeah.
Like nobody got fired for buying IBM, and it's like similar here. And
Do you
recent returns
see
probably
any?
are not going to be as good as an amazing fund one, but they'll be good enough.
Right. And those will be good for the big piles of money that are writing $200 million allocation checks, who also, again, don't want to be fired and don't have to think about it too hard.
You got it.
Do you see any room for like any different, different strategies, whether it's like, what I call like the higher batting average, lower slugging percentage? Can venture do, or is it still the same basic, find high quality primordial soups of people, give them money and ambition and all those things? Is there some other version of this that could evolve? Like, is there a go where they're not strategy that DC could try? Maybe it's not DC anymore, but something else.
I think there's room like now to get alpha in AI. So I don't think there's any like financial engineering type strategy you could do, but in every platform transition, there's new networks, there's new talent networks that become important. And so if I ask today, like who's got the biggest alpha in early stage AI investments, it's hard to say. Maybe one or two people who are pretty private, I would say, but it's not like anyone has a lock on them. And so if you are coming out of like Anthropic or OpenAI or Grok or something like that, and you have a stable of talent and like the smartest young researchers, all of whom are going to leave to start a company in the future, or you're well networked in that space, like you could start a first fund, small first fund, where that's your alpha. And I think that'd be a strategy that's going to work. And so a lot of funds today are looking to hire people who have that sort of bring that network with them. Because,
Right.
we're late stage SaaS right now. That was the old trend. Everyone's mental models are built towards the SaaS world. Everyone's networks are optimized around SaaS world. And so if you are coming in and now you're optimizing your network building and your sort of like mental models around AI world, you're going to do really well.
What about, but on the AI wrapper, like, is there some universe where it's like, okay, my strategy is I'm going to write you $2 million check, some reasonable valuation, and this is the last money you're ever going to raise. And like, this isn't going to be this is not going to be a $10 billion company, maybe it's a $200 million company, but less dilution, more sustainable, less capital consumption. Like, is that a thing? Or is that just a pipe dream? Failure rates are just as high as they ever were. So you have to swing for the fences or else don't swing at all.
I don't know. I kind of think these companies could be bigger than the old companies. So it might work in the opposite direction where there's fewer, like, you're not building the vertical SaaS company for like for Brazilian jiu-jitsu gyms or something like that, which is like really niche. Maybe build $100 million business. Most things people are going after are pretty broad, and you're starting to compete with the like spend businesses have on labor. And those are big opportunities. So I think it could go the other way where you invest in these early AI companies and they actually could be bigger than old companies.
Last kind of question, I know we're way over time, so I appreciate it. Just, this is sort of reflecting on something I think a lot about, is cross-pollination between the asset classes, and partly it's my own interests. And I feel like everything's artificially siloed and there's actually a lot to learn. And you started at Clarium, right? You have done macro stuff and now you do VC. I'm curious, I don't know, like what was Clarium like, and in what sense is macro different or the same than VC? Like, should there be more cross-pollination? Am I wrong about that? I'm sort of curious what your overall reflection is there. Is there enough connectivity between the private equity and VC and bankers, or should there be more? Are they just different things?
Yeah, Clarium was the best job you could have as a young person, I think, on the planet. You got to work with Peter Thiel, which was amazing. And Peter, I think, in his heyday when he just invested in Facebook and right after PayPal acquisition, and Palantir was starting, and get to know all those guys. So it was amazing. Peter, I think, is a great boss. He gives a lot of autonomy to younger people. He hires extremely smart people and gives them a lot of autonomy. So it wasn't a normal finance job where you're, making PowerPoint presentations. I did make some PowerPoint presentations, but you're not making PowerPoint presentations for like 3 levels above MD, and the vice president. VP is like yelling at you all day. You have autonomy. You're encouraged to do independent work. You're given a lot of responsibility. So, and then we just thought about the world. And so it was amazing as a young person to go to a place where All we did was think about the world. It was funny because we were in San Francisco, and so I had a very different view of San Francisco than most people. Like, we came into work every day, nothing, we could talk about anything, nothing was off limits. It wasn't like crazy woke or anything like that. It was just like an intellectual paradise where you could say, I don't want to say anything, you can be rude or hateful or anything like that, but you can question any idea and everyone having a sort of honest and well-meaning discussion about it. Do I think there should be more cross-pollination? I do think there's an element, like one thing that restricts Silicon Valley, I think, is that there is a deep ignorance about finance. And so that will often manifest in like oversimplification of capital structures. People don't take debt very often when they probably should. Funds don't offer very many bespoke products. It's usually a vanilla preferred equity check. Secondary is not as big of a market as it should be. I think a lot of the like debt is not that big. Preferred equity is not that big. I think all of these are derivatives of the fact that tech people don't understand finance. And so that creates opportunity sometimes to create new strategies like maybe a secondaries fund, but it also creates limitations where if you are going to somebody with a more complex product, they kind of assume you're screwing them over. And so there's obviously there's often a reticence to talk about debt or preferred equity or any of these more complex structures, which could make sense for certain companies. And so that's where I see it more on the decision-making side. Like, I don't think many people should make decisions based on macro. It's very hard to predict. So I don't think that should cross.
Is there anything that's easy to predict?
No. Well, maybe, but not in financial markets that I've found. Although I find private markets are more inefficient than public markets. I do think there is an advantage to being a generalist. So in my career, I invest in every area. I've invested in biotech companies. I have a company about to file a BLA, company in phase 3. I've invested in healthcare companies. I've invested in defense companies. Me and Joe invested in Endural. I've invested in software companies. I think there's huge advantage to just being long exceptions and long innovation in any area, because you'll find like innovation clusters and bundles where you'll see a lot of innovation in biotech as like a new idea takes hold or as a new technology takes hold. And then there is an S curve where you'll see sort of a plateau of innovation. And if you are just a biotech investor, you might be investing in an asset class when there's not great innovative opportunities available, and there's perhaps more in defense. And so I think being that generalist would allows you to become a better investor. And I think more firms and more young investors should actually try and go in that direction than they usually do. That's more of a macro idea, but it's not a macro idea in the sense of like knowing what, different asset classes are going to do.
Why do you think that there aren't more places like Clarium, like that you described, like, super smart people, fair amount of autonomy, anything goes? Why is it so unusual? Maybe it's not.
I think it is. I think global macro is an asset class where like this type of analysis, where it's like you're much more long creativity, and everything we did and invested in at Clarium was always an exception, right? Because you're not doing like systematic quantitative trading, where most places have become more quantitative. And even where there is discretion, there's these things called pod shops. It's being put in more of like a quantitative box where you'll take like groups of discretionary traders and treat them quantitatively and size up their assets when they're doing well and size them down when they're losing. So even like discretionary trading has become more quantitative. And so, and that's because global macro as an asset class has underperformed. You've seen, I think it's a little bit because it's hard to do the like George Soros thing. Like, I do think there's just N of 1 personalities who are very good at it. Like Druckenmiller has never lost money in the markets. That's clearly an exception. There's not a lot of people like Druckenmiller. But you've also had the zeitgeist in the markets of the last, say, 15, 20 years since the financial crisis has been central banks printing money. And that means the trade is buy everything.
Yeah,
and so
just buy.
There's not a lot of discrimination on the global macro side of like, I'm going to buy this and short this. It was buy everything. And so when you just buy equities, you make 30% a year. Why do you need a global macro hedge fund?
But why is it, putting aside macro as the answer goes, but why is it investing like at an organizational cultural level? Why aren't there more places like that? Like everybody, I always say that, for alpha, but supposedly an alpha seeking industry, like investment on the public's privates, they're all surprisingly conventional, like in terms of how they hire and structure their firm. So is it just like as a risk? Is it downside? Like what? I don't know. I don't have a good theory as to why that's true.
We always thought that there were huge institutional forces in finance that push you towards a consensus. If you make money and lose money together, you don't stand out, but you don't fall behind the pack. And so you keep your job. And I think that's always the issue in finance is you don't get paid to be heterodox. And to be honest with you, like most of the
That's what
time you
alpha
don't want to
is.
go there.
Literally, alpha is being paid to be heterodox, right?
Yes, but these like large mispriced opportunities don't exist all the time. And the way, like, why does finance exist? Finance exists to supply capital to the economy at good rates of return. And so there are huge returns to specialization of saying, like, okay, for the next 10 years, we need to build data centers. And so you should get really good at understanding what about a data center gives you a good return on the data center. And if you could spend a lot of time learning how to like incrementally improve the data centers you build, then that's really good for the economy and that will give you alpha too. And so it's not like the economy actually does work better when people specialize. And that's why you see a lot of specialization in finance, because most like the GDP grows 2 to 3% every year. Maybe it's 1 to 3% every year. Not always because there's like huge innovations happening. It's because there's like incremental learning by doing that happens through specialization. And that's good. And
Yeah.
like most people should be doing that. So that's why I don't think you should have these, everyone should be a George Soros or something like that. It should be
Right.
always an exception. And we should just learn how to like, roll up veterinary clinics really well. And that you should make alpha doing that.
Yeah, so the bottleneck is just that there's the Thiels and the Druckenmillers and the Soroses of the world.
It's that and the fact that the economy doesn't need too many people doing that.
It's Ricardian economics and specialization in trade. Who wins a game of Survivor? Hedge fund pod boys, PE bros, or VC?
I don't know. That's a
Last
good question. I'd say tech bros. Tech bros. We've had a lot of very good experience being tech bros and being attacked and stuff like that. So they're not gonna falter under any heat.
I like it. It's good. It's good. Pick the home team also.
Yeah.
All right, Alex, this was great. I really appreciate it. Give me a lot of time. This, I don't know if if you want any final word, but I've asked. I mean, I could go on forever, but
No, it was a great, fun conversation.
Okay. All right. Thanks very much.
Thanks,
All right,
man.
we'll talk soon. Yep.